So the other day, I got a text from a friend and he told me, Ankit, everyone is talking about the stock market, but no one explains what it is. What exactly is the stock market and what am I getting into if I start investing? And you know what? That is an excellent question and it's something a lot of people wonder. So today, I'm going to break down exactly what the stock market is, how it works, and by the end of this video, you will have a complete picture of how everything fits together, from IPOs to index funds and everything that comes in between. Let's get started. So let's start with the basics. Imagine you own a business and you want to expand. You might need more money to fund that growth, maybe for new products, marketing, or expanding into new markets. One way to raise that money is by doing something called an IPO, or an initial public offering. That is when a company decides to sell parts of itself to the public in the form of shares. When you sell shares, people pay money to buy them. For example, if you price each share at $10 and someone buys 10 shares, then they have invested $100 into your company. The company can then use that $100 to grow its business. So now let's say your company is doing really well from the money you raised with your initial public offering. So your business is booming, you use that money to invest into new shops and new employees, and now people are taking interest in your business. Why? Because it is booming and people want a piece of it. So you initially sold your shares for $10 a piece and now someone else is willing to buy it for $15 a piece, with the hope that in the future your business will be even better and he will be able to make a profit by selling it for $20. That is the fundamental way how the stock market works. So he would then go to the stock market and asks the people who own your company shares to sell you or sell him a piece of your company for a higher price. That is the stock market. So people buy shares hoping that the company will continue to grow, which would also make the shares more valuable over time. On the flip side, if the company performs poorly, demand for the shares can drop, causing the price of the stock to go down. So this is the fundamental idea behind how the stock market works. So now that you understand how the stock market works, you want to buy a piece of a company. But where do you get started? How do you know which companies are good to buy and which are bad? Well, like most things in investing, there is no straightforward answer to that. However, there are a few key metrics that you can use to assess the health of a company. This is what all investors look at when they are trying to understand if a share is in good health or bad health. Number one, earnings per share. Earnings per share is essentially the company's total income divided by shares outstanding. What does it mean? Let's say when you did an IPO for your company, the initial public offering, you divided your company's assets into 100 equal parts or 100 shares. So you gave the market 100 shares to buy and your company is making $1,000 per year. That means that the earnings per share for your company is $10. Why? Because the whole company is making $1,000 and each share is then making $10 because you have 100 shares of your company. It's as simple as that. Number two, PE ratio. So PE ratio or price to earnings ratio is the price of the stock divided by what we just discussed, earnings per share. So it tells you how expensive or cheap the stock is relative to the earnings. So what is a good PE ratio? Again, there is no straightforward answer to this. Many people always tend to go for a low PE ratio, like they want to buy stocks which have a PE ratio under 20 or under 18 or something like that. But that's always not the right approach, because when you are comparing PE ratios, you have to compare with the stocks in the same sector. For example, technology sector might often have a higher PE ratio compared to consumer staples. So you have to compare with other companies in the same sector what their PE ratios are, and then you can decide if the stock is undervalued or overvalued. Number three, free cash flow. So this is the money the company has left after paying all of its expenses, including the salaries, reinvestments back into the company, and so on. So as you can imagine, this is an important measure because it tells us how profitable a company is and also how self-sustaining the business can be. And number four, this is not really a new term that you need to remember, but simply to understand the management. Investors often assess the quality of a company with the company's management. Are they experienced? Have they made smart business decisions in the past? because good leadership can make a huge difference in a company's success. Now let's be honest, we have only scratched the surface of how to pick stocks and it already seems like too much work. It's not impossible, a lot of people do it, but a lot of people are also not looking for that. They want a simple, straightforward approach to investing. That's where indexes come in. Let's talk about indexes. So in simple term, an index is a collection of stocks that represent a specific part of the stock market. For example, the S&P 500 is one of the most well-known indexes in the world, and it is made up of the 500 largest companies in the United States. So think of it like a snapshot of the market. Instead of following just one company's stock price, an index will track the performance of many companies altogether. So this gives you a clearer idea of how the overall market or economy is doing. For example, if the S&P 500 is going up, it usually means that the largest companies in the US are performing well. So almost every country that you can think of where you can invest your money in will usually have an index or sometimes multiple indexes. So we talked about the S&P 500 in the United States. We have, for example, the DAX in Germany. It tracks the 30 biggest companies of Germany. We have Nifty in India. It tracks the 50 largest companies in India. In Japan, we have the Nikkei 225. In UK, we have the FTSE. So there are many options for you to choose from. The only thing you need to be careful about is make sure that the country's fundamentals are looking strong when you're investing in that country's index. So now that you understand what indexes are, let's talk about how you can invest in them. One of the most popular ways to invest in an index is through an ETF. But what exactly is an ETF and how does it differ from an index fund? So an ETF or exchange traded fund is a type of investment fund that tracks the index like the S&P 500, but unlike a traditional index fund, you can buy and sell ETFs just like a stock on the stock market. This means that you can trade them throughout the day at market prices. So ETFs give you the flexibility to invest in an entire index with a single purchase, but you get the convenience of being able to buy or sell them at any time during the day. It is important to note though that not all ETFs track indexes. Some ETFs are designed to track a specific sector, some are designed to track a commodity or even a particular investment strategy. So it is important to check whether an ETF is tracking an index or something else before investing in it. For more information on how to pick an ETF, you can check out my other video. I've put a link in the description box where I talk about how to pick the right ETFs for investing. So another financial term that you might have commonly heard is mutual funds. What is a mutual fund? Mutual funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, commodities, or actually it could be any one of them, or it could be even more assets because there is a really broad spectrum of what a mutual fund can be. However, the one key difference is mutual funds are usually actively managed, meaning that a professional fund manager makes decisions on which assets to buy, which to hold and which to sell, in the hopes of beating the stock market. So because of this active management, mutual funds will typically have higher fees compared to ETFs. So let's wrap it all up. What have we learned today? We learned that the stock market allows you to own a piece of a company, and as that company grows, your shares can become more valuable over time. But picking individual stocks comes with a risk, and it also comes with a lot of effort from your end, which is why many investors turn to index funds and ETFs to diversify and reduce the risk while still benefiting from the market's incremental growth. That is all for today. Thank you for watching Dimes to Dreams. If you found this video helpful, don't forget to subscribe and hit the bell icon to stay updated on our latest videos. Thank you and see you in the next one. Bye-bye.